When people buy the Nasdaq-100, they think they are buying 100 of America's biggest, most diversified companies. Tech, retail, healthcare, media, a whole basket of innovation in a single ticker. It is one of the most popular investments on Earth, sitting in millions of retirement accounts. But that picture of a broad, balanced basket is mostly an illusion. Look at what actually carries the weight, and a very different index appears. Start with the simplest test of how spread out an index really is. Out of all 100 companies, how much sits in just the 10 biggest? If everything were balanced, the top 10 would be around 10%. Instead, as of June 2026, the 10 largest holdings make up about 45.7% of the entire index. 10 names, nearly half the whole thing. The other 90 companies share what is left. So who are these giants? Here are the top holdings, ranked by weight. Apple, Microsoft, Amazon, the names everyone expects. But look closer at who joins them near the very top. Nvidia, in first place. Then Micron. Then Advanced Micro Devices. Then Broadcom, Intel, and the equipment makers. The companies doing the heaviest lifting in this index are not social networks or online stores. More and more, they design and build semiconductors. Add up every chip maker and chip equipment company in the index, and the scale becomes clear. By weight, semiconductors alone make up about 30% of the Nasdaq-100. And that is a conservative floor, counting only the chip names large enough to reach the published top holdings. Include the smaller ones, and the true figure pushes toward a third. The index that markets itself as broad technology is, underneath, a concentrated bet on one deeply cyclical corner of tech, the companies that make chips. Picture pulling those semiconductor names out and standing them up as their own little index. Nvidia towers over everything at 8%, Micron over 5%, then AMD, Broadcom, Intel, and the quiet giants of chip equipment, Lam Research, Applied Materials, KLA. Each one is a meaningful slice of the whole Nasdaq-100 on its own. Together, this single industry shapes where the index goes on any given day. So let us hold the illusion and the reality side by side. 100 companies on the label, but about a third of the weight is semiconductors. Nearly 46% sits in just 10 holdings. And here is the one most people never guess. The number of banks, insurers, and financial firms in the Nasdaq-100 is exactly 0. By design, this index leaves out an entire pillar of the economy. Zoom out to the famous cluster everyone talks about, the Magnificent Seven. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. 7 companies out of 100. If the index were balanced, those 7 would be around 7% of it. Instead, they command roughly 37%. More than a third of every dollar in the Nasdaq-100 rides on the fortunes of just 7 names. The other 90-plus companies split the rest. This concentration is not only about individual stocks. It is about sectors. Group every holding by its industry, and one sector swallows the rest. Information technology, on its own, is about 59% of the Nasdaq-100. Nearly 6 of every $10 in the index sits in a single sector. There is no second pillar anywhere close. When tech has a good day, the index has a good day. When it stumbles, so does everything else. Here is the full sector picture. Technology, at 59%, dwarfs everything. Communication services, the home of Alphabet and Meta, adds around 14. Consumer discretionary, led by Amazon and Tesla, about 11. After that, the slices get thin fast. Consumer staples, a little healthcare, almost nothing else. The top 3 sectors together are about 84% of the index. This is not a diversified market. It is a concentrated bet wearing a 100-company costume. And notice the giant hole in that chart. The number of financial companies in the Nasdaq-100 is 0. No banks, no insurers, no real estate trusts. The index rules specifically exclude every company classified as financial. So the sector that arguably runs the modern economy, the one that moves money itself, is completely missing. What you are left with is a machine tuned almost entirely to technology, and especially to the companies that power it. Compress the whole index into a single bar to see where the weight lives. The 8 largest companies alone fill almost half of it, around 43%. The next 17 companies take up roughly another third. And the entire long tail, the remaining 75 or so names, the small and mid-sized members most investors could not even list, share what is left. In an index of 100, the bottom most companies barely register at all. Why does it end up this lopsided? Because of how the index is built. It is market cap weighted. The bigger a company's market value, the bigger its slice. Nasdaq does layer on caps to stop any tiny group from running away, including a rule that the 5 largest cannot hold too much, and it rebalances 4 times a year. But between those resets, the giants are free to grow. And lately, they have grown enormously. To feel how extreme this has become, look at a single company. Nvidia, on its own, is about 8% of the entire Nasdaq-100. One stock, 8% of an index of 100 companies. That means Nvidia, by itself, carries more weight than the smallest 50 or 60 members of the index combined. A single chipmaker's earnings report can now move the whole index more than dozens of other companies put together. This is not the first time the index has tipped over. 3 times in its history, one company or a small cluster grew so large that Nasdaq had to step in with an emergency, off-schedule rebalance. In 1998, Microsoft alone neared 25% of the index. In 2011, Apple commanded around 20%. And then came the third, the most famous of them all, in the summer of 2023. Stop and sit with that number. In the entire history of the modern Nasdaq-100, there have been only 3 of these emergency rebalances. 3 times the index became so concentrated that the normal quarterly schedule was not enough, and Nasdaq had to perform special surgery to spread the weight back out. 1998, 2011, and July 2023. Each one marks a moment when the giants simply got too big. Here is exactly what triggered the 2023 intervention. The index has a rule borrowed from fund diversification law. Add up every company weighing more than 4.5%, and that group cannot exceed 48% of the index. By early July 2023, that group had climbed to 50.9%. The biggest companies had quietly broken the index's own ceiling. Nasdaq had no choice but to force them back down. So on July 24, 2023, the giants got a haircut. No company was added or removed. The weights were simply rewritten overnight. The combined weight of the top 7 was cut from around 55% down to roughly 43%. Microsoft, then the largest, fell from nearly 13% to under 10%. Nvidia was trimmed from almost 7% to just over 4%. In a single day, the top of the index was reshaped. But here's the twist. Capping the giants did not keep them down for long. Look at the weights right after that 2023 cut, and again in June 2026. Nvidia was trimmed to about 4%. Today it is back above 8%, nearly doubling its share. Microsoft, meanwhile, slid from nearly 10% down to under 5%. The index did not become less concentrated. The concentration simply reshuffled toward the chip makers. That reshuffle is the real story of the last 3 years. Nvidia has roughly doubled its weight since the 2023 rebalance, becoming the single largest company in the index. Micron has climbed all the way to number 3, up from outside the top 10. Advanced Micro Devices has muscled into the top 6. Stock by stock, an index that used to be led by software and retail has been quietly taken over by semiconductors. How much of this is the companies, and how much is just the math? There is a clean way to test it. Nasdaq also publishes an equal-weighted version of the exact same 100 stocks, where every company gets the same 1%. Under that version, the Magnificent 7 are about 7%. Under the normal cap-weighted index, the same 7 stocks are around 37. Same companies, same day. The weighting rule alone changes everything. Look at the gap. Flip from equal weighting to cap weighting, and the 7 biggest companies jump from roughly 7% to about 37%. That is more than 5 times the exposure to the same handful of names, created not by the businesses themselves, but purely by the rule that bigger means heavier. When you buy the standard Nasdaq-100, you are not buying 100 equal bets. You are buying the giants, amplified. Now, to be fair, this concentration is exactly why the index has soared. Because the biggest companies were also the best performers, leaning into them paid off enormously. Over the past 10 years, the cap-weighted Nasdaq-100 returned around 22% a year. The equal-weighted version of the very same stocks returned about 15.5%. Tilting hard toward the giants did not just add risk. For a decade, it added a lot of return. But a decade of one strategy winning is a result, not a promise. And it is worth being clear about what this video is and is not. It is a description of how an index is built and where its weight sits. It is not advice about what you should do with your money. Even Nasdaq says so in the fine print of its own methodology. Nothing contained herein should be construed as investment advice. A few honest caveats before you draw conclusions. Concentration is not a scandal. It is a feature of every market cap-weighted index. And the giants are heavy because they are genuinely huge and profitable. The exact weights change every single day with prices, so every number here is a snapshot, not a constant. And crucially, the fact that concentration paid off over the past decade tells you nothing certain about the next one. So what do you actually own when you buy the Nasdaq-100? On the label, 100 companies. Under the hood, about 8 of them carry the real weight, and a growing share of that weight is a bet on semiconductors and the artificial intelligence boom driving them. It is still a powerful, popular index. It is just nowhere near as diversified as its name suggests. Now you know what is really inside.